bit of a sticky spot in that sense. Let's welcome in Jayesh Mehta as well. He's a former MD and country treasurer at Bank of America. Jayesh, great to have you with us here. Thank you very much. I mean, we should correct that super. Formerly with Bank of America, no longer. Jayesh, apologies. Thank you for joining us. I mean, you heard Latha there talk about the inflation number. Of course, I mean, December is out of the question. But as Latha was saying, even February may be a little doubtful. How do you read these numbers?
So this, as far as bond market is concerned, they were expecting 6% print this month. Now 6 or 6.2 is not really much of a difference. So December rate cut is completely out. Of course, equity market was looking at some ray of hope in some so much of selling. Otherwise, for them, it really does not matter. But there was some hope they were looking at from a December rate cut. So that's not going to happen with this print coming in. Now, the question is whether they will be dovish or hawkish, or will they roll back the liquidity which they have been providing. I don't think so. That would continue. That liquidity will continue because at the same time, your growth is really, really struggling. We have seen all the, numbers of the corporates. So that's really struggling. But February looks quite optimist because if you really look at it, this was supposed to be if you look at history, if you look at the past data, this was supposed to be the highest print as far as bond market was expecting on inflation. And now going forward from next month, we'll see inflation coming off all the way to March. And yeah, there may be some mild change from their projection, maybe by 10, 20 basis points, but that's not going to be a material change from a range of 2 to 6%. So it will be still near 4%. And I'm more optimist on U.S. rate cuts going forward. So by February, we will have at least one more rate cut from U.S. That will have definitely a lot of pressure, especially when your growth is down in February to cut rate. Because if the growth was also up, GDP growth was up, and the inflation was around 470, 460, you may still not do anything. But at 470, 460 forecast for inflation in February, and with GDP coming down, you have to go for a rate cut. So I do expect a February rate cut.
But Jayesh, only looking at the 10-year, do you think the yield seems to have bottomed out? Remember how cheerful we were about 3 or 4 months back? There was bond inflows coming in. We got included in the index. The fiscal deficit was lower than expected. And we were all expecting a rate cut probably in December or at least in Feb. There were people talking about 6.5 on the 10-year. But now do you think the yields have bottomed? We shouldn't be expecting too much by way of fall in yields.
So 675 without rate cut, which we saw, and then it moved to 672, and now it's back to 683, maybe 1 or 2 basis point higher today because of U.S. interest rate, right? You look at the U.S. interest rate, the way they have moved, we have hardly moved. So to that extent, we are still hugging, and the bond market is still looking at, okay, if not December, we still look for a rate cut in February, right? So that's when, when you become 6/4 from 6.5, 650 going forward would look difficult. But yeah, you're right. So to an extent, maybe if we get a rate cut, we'll be still looking at 655, 660. But to that extent, from now to February, that's when it will depend more on, if U.S. still falls by another 15, 20 basis point, we might see 3 basis point rally. If it goes up, we may see 2 basis points. Goes up by 15, 20 basis points, we may see 2, 3 basis points higher, right? So, but it would be more of just technical. But fundamentally, people would still go and bet for 665, 660 kind of levels crossing February.
Jayesh, and the other thing which has been remarkably stable has been the rupee. I mean, it's very orderly kind of, it's been under pressure. But do you think, to put it in context, we should look at what's happening with the Chinese currency? I mean, if the call here is that as China gets tariffed at higher rates and there's disadvantage India, for that you need the currency to be at a stable equilibrium. If the CNY goes down sharply and you don't match it, I mean, exports become become uncompetitive. Is that the context to look at things?
Definitely. So, if you look at it historically, when we see RBI letting a level go, right, it's always because of Chinese, currency depreciating. Now, if that happens, but, it's all too early, even for U.S. Even if you look at it, like there are certain things on U.S. people are projecting based on past, right? Like Trump will go and really do a huge fiscal deficit, which doesn't look like. That doesn't look like, you say 2016 was different. Today it is very different. Again, with everything, all the three majority having a Republican, the spend may not be so riff-raff. Like when you have multiple people ruling it, the spend actually goes much larger. Here it will be just headline announcement. The spend may not be. So I really think the deficit would be much lower than what market expect. Of course, we'll come to know only after January, February, or that's the time we will come to know. So that's one part. Even on tariff, right? See, when the first tariff was raised for China, they didn't have other manufacturing. Now the Chinese companies are everywhere, right? So where do you price the tariff? So to that extent, and even U.S. also realizes that, right? So there will be token tariff hike, but I don't really see that major tariff hike, because if you put tariff hike with China, the Chinese companies are there in the rest of the world, right? Like, so where do you put the tariff?
No, absolutely. And point taken. So it's early days. As someone said, Trump is the same, but the world is different compared to 2016. We'll speak again. Jayesh, thank you very much for joining us. Latha, thank you very much for taking us through.
About this tariff part, Morgan Stanley did a modeling. It's just modeling. If you raised all the rates that Trump promised, 60% on all Chinese goods and 10 to 20% on other goods, then inflation goes up by 90 basis points in their curve. And growth falls by 1.5 percentage points. So that would be shooting yourself in the leg. So Goldman Sachs did another thing. Because you can't raise everything, you make your own fuels and foods expensive, they have taken 20%. Even then, they see US growth going down. So, I think that in self-interest, it may not be as bad as the rhetoric.
Yeah, absolutely. We'll watch the space closely, Latha. Thank you very much for that. We'll take a quick commercial break.